So in the last explainer, I did something a little controversial. I sold a really popular high-flying stock, and you might be asking why. Well, it was to fund what I believe is a much, much better opportunity. Today, we're going to walk through that exact trade, selling the hype to buy the value. Let's get right into it.
So, I sold Palantir, and the reason is simple. Its valuation was pure hype. I mean, we're talking over 600 times earnings, priced for a level of perfection it just wasn't delivering. So I took that capital and I rotated it into what I see as a true value story, SoFi. And here's the really important part. The market is pricing SoFi for just 12% growth, but the business itself is delivering over 25%. You see that gap between perception and reality? That's where you find the real investment opportunities. And look, this isn't just some theory I'm talking about. SoFi is my single largest position in my portfolio, valued at roughly £19,000. It makes up nearly a quarter of my entire portfolio, and for a very good reason. I really consider it the anchor investment, the one that provides stability and lets me sleep at night.
So what is it that gives me such high conviction in this one company? I mean, why have I made it the absolute bedrock of my entire portfolio? Well, let's break down the bull case.
My entire thesis really rests on two incredibly powerful pillars. First up is the bank charter. This gives them a structural advantage, a powerful moat that most of their competitors simply cannot copy. And second, there's what I like to call the AWS of fintech, which is this hidden gem that I think most of the market completely ignores.
So this brings us to the AWS thesis. This is the part of the business that so many investors just seem to miss. SoFi actually owns Galileo, a platform that provides the core technology for a ton of other fintech apps. It's a classic picks and shovels play. This means that even if SoFi's own consumer app has a slow quarter, the company still gets paid every single time you use a competitor's app that happens to run on Galileo's infrastructure. It's not just a bet on one player, it's a bet on the entire fintech ecosystem.
But look, conviction without scrutiny? Well, that's just being a fanboy. To really manage risk, I have to try and actively destroy my own thesis. So I turned to my AI agent, Mary Jane, and I gave her a pretty simple job. Act as my chief risk officer and find the fatal flaws in this entire investment.
I gave her a very, very specific prompt. I didn't want any of the good news. I said, ignore the hype, act as a short seller. Why does SoFi go to zero? You see, this process of actively trying to poke holes in my own best ideas, well, that's absolutely crucial for long-term investing.
So right away, Mary Jane flagged the biggest external threat, a macro recession. It makes sense, right? As a lender, if unemployment spikes, loan defaults could skyrocket and just crush the stock. But here's the counterargument, and it is all in the data. SoFi's average borrower has a FICO score over 750 and earns about $160,000 a year. We're talking about some of the most resilient consumers in the entire economy. Okay, the second major risk is an internal one, stock-based compensation. This is when a company pays its employees with new shares, which dilutes your piece of the pie. And make no mistake, it is a real risk that can silently kill your returns. However, the data shows that the CEO, Anthony Noto, is actively managing this, and crucially, the company's revenue is growing much, much faster than this dilution. As long as that stays true, the core investment case holds up.
Okay, so the fundamental story is strong. It seems to hold up. But what does the data say right now? After you understand the what to buy, you've got to look at the when. So let's check the data dashboard for the quantitative picture.
In this dashboard just makes the quantitative case crystal clear. Let's look at the RSI, the Relative Strength Index. It basically measures the stock's momentum. Now, anything over 70 is generally considered overbought. When I sold Palantir, its RSI was at 80, a flashing red light to take some profits. SoFi, on the other hand, is sitting at a really healthy 62. It's not overextended, and sentiment is actually improving. The system signal is clear: hold or accumulate.
So, after interrogating the thesis, weighing all the risks, and looking at the hard data, what is the final plan of action? Remember, I've got over £8,000 in cash just sitting there from that Palantir sale, and that capital needs a job. It is time to put it to work in a value-focused position.
So here is the plan. It's simple. I am holding all 882 of my shares, and if the stock price happens to drop below my technical support level of $13 and there's no new negative information, I'm going to use that cash to buy more, rounding up my position to an even 1,000 shares.
And there it is. That's my actual holding. This isn't theoretical. This isn't a game. This is the real anchor of my portfolio. And honestly, seeing it right here just reinforces my conviction in all the deep work we've just done. I'm not just holding, I'm actively prepared to accumulate. So what's next? Well, we've just stress tested my largest position. So in the next explainer, we are putting my second largest holding, AMD, through the exact same ruthless interrogation.
You know, that really brings us to the core takeaway of all of this. This is the difference between gambling on hype and actually investing in value. I sold a great company that was at a terrible price to fund a great company that's at a fair price. My name's Joe. Defend the compounding. I'll see you in the next one.